Welcome to the April 2026 investment strategy. I'm Vishal.
And I'm Sharvari.
Let me be upfront. This is not a comfortable month to talk about markets.
No, it isn't Vishal. Markets have seen double-digit declines across the board. Crude oil is above $100. West Asia tensions have escalated sharply, and Nifty has dropped over 12% in March alone. Is this a correction or something deeper?
That's the big question, Sharvari. Let's break down what the data tells us, where the risks are, and importantly, how to position your portfolio right now. Let's go.
The scoreboard is uniformly red. The Nifty 50 and Nifty 100 are both down around 12%. Mid-cap and small-cap stocks are down roughly 11%. There's nowhere to hide this month.
The uniformity is what stands out, Sharvari. When large caps and small caps fall by similar margin, it usually means the problem is not with individual sectors or companies. It means big global issue is affecting everything. This is the West Asia shocking working through markets.
Sectorally, pharma was the most resilient, falling just 2%. But IT, metals, chemicals, FMCG, autos all corrected 9 to 15%. The worst hit, realty, down 19%. Banking and financial services fell around 16%.
Rate-sensitive sectors being the worst performers tells you the market is pricing in a possible pause in RBI's rate cut trajectory because of crude oil-driven inflation.
FII outflows crossed rupees 1 lakh crore in March. Massive. DIIs cushioned with rupees 1.19 lakh crore. But can domestic flows keep absorbing this, Vishal?
For a while, yes, but not indefinitely. For FIIs to return, two things must happen. First, companies must show clearer earnings growth. Second, tensions in West Asia must reduce. The silver lining, Nifty forward P has dropped to 17.9, well below the 3-year average of 20.4. Valuations are genuinely attractive now.
The elephant in the room now, Vishal, is the US-Israel-Iran conflict, which has pushed crude oil past $100. How does this specifically hurt India?
India imports most of its crude oil. So, when oil prices rise, India has to spend more money on imports. This increases inflation, puts pressure on the rupee, worsens the current account deficit, and impacts corporate margins. The government's diversification of oil sources has eased the impact somewhat, but the risk is real.
The Indian rupee weakened to rupees 94 per US dollar, marking a 2.5% depreciation in March, reflecting sustained pressure from global dollar strength and portfolio outflows. Globally, the US Fed held rate steady. US CPI is at 2.4% and the 10-year Treasury yield hovers near 4.4%.
The key global takeaway here, Sharvari, is that most central banks are reaching the end of their interest rate cut cycles. Whether rates are cut further will depend on local inflation and how long the conflict continues. High interest rates for a longer time is no longer just a US issue. It is happening worldwide.
And interestingly, even gold is losing its safe haven appeal. Why is that, Vishal?
Because crude oil driven inflation reduces the likelihood of interest rate cuts, keeping the dollar strong. A strong dollar pressurizes gold. Investors who assume gold always rallies during geopolitical stress are getting a surprise. It's a unique environment.
Vishal, the 10-year India G-Sec yield surged 19 basis points to 6.86%. What's driving it?
Three things are converging here, Sharvari. Crude oil is keeping inflation expectations elevated. Second, there is a tight system liquidity from GST outflows and advanced tax payments pushing up overnight funding costs. The call rates rose from 5.10% to 5.32%. Third, markets now believe RBI may not cut rates soon. It's a triple squeeze on bonds.
February CPI came in at 3.21%, up from 2.74%. It is still within RBI's comfort range, but it is clearly rising. And the new CPI series matter here, right, Vishal?
It is critically important. The new CPI gives higher weight to energy components. So, if crude oil stays elevated, inflation can rise faster than before. The Monetary Policy Committee is expected to adopt a wait and watch approach. monitoring the conflict's impact before making any moves.
So, Vishal, with all this uncertainty, what's the strategy?
Near-term challenges are real. Crude oil above $100, geopolitical risk, FII outflows, weakening rupee. But structural supports haven't vanished. India's trade agreements, PLI incentives, China plus one manufacturing shift, and strong domestic liquidity remain medium-term cushions. Valuations at 17.9 PE are genuinely attractive.
So, what is the clear action investors should take?
Investors should favor large caps for stability, Sharvari, and add mid caps and select small caps gradually, not all at once. In debt investments, focus on short term and income generating funds because interest rate cuts may be ending, and gold stays in the portfolio as a hedge. Now, let's get specific. The report lays out model portfolios for different risk profiles.
This is where it gets really practical. Let's walk through the model portfolios, starting with the aggressive portfolio. Who is this suited for, Vishal?
This is for investors who can stomach volatility and have a long term horizon. The allocation is 35% to mid caps, 20% to large caps, 20% to small caps, 15% to flexi cap, and 10% to thematic funds. Fund picks include Mirae Asset Mid Cap White Oak Capital Mid Cap, Mirae Asset Large Cap, Parag Parik Flexi Cap, and thematic plays like Mirae Asset Great Consumer Fund and ICICI Prudential Manufacturing Fund.
The moderate portfolio looks quite different, right?
Very different, Sharbari. It balances growth with stability. You've got 25% in mid caps, 15% in large caps, 12% in small caps, but then 23% goes to corporate bond and short duration funds, 15% to balance advantage funds, and 10% to gold. Funds like Mirae Asset Short Duration, Kotak Corporate Bond, and Mirae Asset Balance Advantage Fund provide that downside cushion.
And for the conservative investors, Vishal, the ones who just want to beat FD returns with minimal stress?
A full 70% goes to corporate bond and short duration funds in names like Aditya Birla Sun Life Corporate Bond, ICICI Prudential Corporate Bond, Mirae Asset Short Duration, and HDFC Short Term Fund. Then 20% in balance advantage and 10% in gold. This portfolio prioritizes capital preservation with modest real returns.
There are also two specialty baskets, right, Vishal?
Yes, Sharvari. There's a regular income basket for lump sum investors wanting steady income, with 70% in balance advantage and 30% in multi-asset allocation funds. And a Build India basket for those who want to ride the domestic manufacturing and consumption story with 80% in thematic funds like Mirae Asset, Great Consumer, and ICICI Prudential Manufacturing, plus 20% in flexi cap and multi cap.
There are three takeaways to close. First, this correction has brought valuations to genuinely attractive levels, well below the 3-year average. Second, crude oil and West Asia tensions are dominant near-term risks, so monitor them closely. Third, don't panic. Pick the model portfolio that matches your risk profile, invest gradually, and keep gold as strategic hedge instead of a return-generating asset.
Perfectly summed up, Sharvari. And an important reminder, everything we discuss comes from the Mirae Asset Sharekhan April 2026 Investment Strategy Report. Always consult your financial advisor and read all scheme documents before investing.
If this helped you make sense of a chaotic month, like, subscribe, and share. See you next month.
Stay calm, stay diversified. Happy investing, everyone.
Mutual fund investments are subject to market risk. Read all scheme and related documents carefully before investing.